Hello and welcome back to Time Capsule, Stories That Shaped the Era. I'm Alex Monroe, and I'm thrilled to dive into another pivotal moment in history with you. In today's episode, titled 2008, The Global Financial Crisis, Collapse and Recovery, we'll take a close look at the events that led to one of the most significant economic downturns in recent memory and explore the remarkable recovery that followed. So grab your favorite beverage, get comfortable, and let's embark on this fascinating journey together. The housing bubble of the mid-2000s was a key factor in the onset of the global financial crisis. Let's take a moment to understand how this bubble formed and eventually burst, sending shockwaves throughout the world. In the years leading up to the crisis, there was a dramatic increase in the demand for housing, fueled by easy access to credit and low interest rates. This led to a surge in housing prices, which in turn created a speculative frenzy as people rushed to invest in real estate. As the housing market continued to heat up, financial institutions were eager to capitalize on the opportunity, offering subprime mortgages to individuals who may not have qualified for traditional loans. These risky mortgage products, along with complex financial instruments built on top of them, masked the true risks of the housing market and created a ticking time bomb. When the bubble finally burst, housing prices plummeted, leaving many homeowners with mortgages worth more than their homes. This wave of foreclosures sent shockwaves through the financial industry, ultimately triggering a full-blown global financial crisis. Understanding the housing bubble is crucial to comprehending the events of 2008. It serves as a cautionary tale about the dangers of unchecked speculation, unsustainable lending practices, and the interconnectedness of global financial markets. Join us as we continue to explore the factors that led to the collapse and the steps taken towards recovery in our next section. As financial institutions across the globe face the fallout from the subprime mortgage meltdown, the once solid foundations of major banks began to show cracks. The domino effect of bad loans and risky investments led to a chain reaction of financial instability, leaving banks on the brink of collapse. During this tumultuous time, many banks found themselves grappling with mounting losses and declining asset values. The once trusted pillars of the financial industry were now struggling to stay afloat, dealing with the repercussions of their high-risk lending practices and overexposure to toxic assets. As the crisis deepened, the impact reverberated through the entire financial system, causing a crisis of confidence among depositors, investors, and counterparties. The interconnected nature of the banking sector meant that the distress of one institution could have far-reaching implications, potentially triggering further failures and exacerbating the already precarious situation. In response to this unprecedented challenge, governments and central banks were forced to intervene, injecting liquidity and implementing rescue measures to stabilize the financial system. These actions aimed to restore confidence, prevent a systemic collapse, and facilitate the orderly resolution of troubled institutions. Amidst the turmoil, it became evident that the health of individual banks was intricately linked to the overall stability of the global financial framework. The events of 2008 underscored the vulnerability of even the most prominent financial institutions and underscored the imperative of effective risk management and regulatory oversight in safeguarding the integrity of the banking sector. As the saga of the global financial crisis unfolded, the resilience and adaptability of banks were put to the ultimate test. The steps taken to address the challenges of the crisis ultimately shaped the trajectory of the recovery and paved the way for a renewed focus on risk mitigation, capital adequacy, and sustainable growth in the banking industry. In 2008, the global financial crisis sent shockwaves through the world economy, causing widespread job losses and economic turmoil. millions of people found themselves suddenly unemployed as businesses struggled to stay afloat in the midst of the crisis. Families faced the harsh reality of financial uncertainty, and the ripple effects of the economic downturn were felt far and wide. But amidst the darkness, there were glimmers of hope. Governments and organizations worked tirelessly to implement measures aimed at stabilizing the economy and creating opportunities for job growth. As new policies were put in place and industries adapted to the changing landscape, we began to see signs of recovery. The resilience of individuals and communities during this challenging time was truly inspiring. Many found new ways to adapt, retrain, and re-enter the workforce, demonstrating incredible determination and perseverance in the face of adversity. As we reflect on this period, it's important to recognize the lessons learned and the resilience that emerged from the crisis. The global financial meltdown of 2008 was a stark reminder of the interconnectedness of our economy and the need for proactive measures to safeguard against future instability. It also served as a testament to the strength and resilience of individuals and communities in the face of economic hardship. In the next section, we'll explore the impact of government interventions and the road to recovery in the aftermath of the crisis. Stay tuned to learn about the measures that helped rebuild confidence and stability in the global economy. Now let's dive into how the global financial crisis affected different regions around the world. In North America, the housing market crash led to a severe economic downturn, with thousands of families facing foreclosure and job losses. Across the Atlantic in Europe, countries like Greece and Spain experienced significant debt crises, leading to austerity measures and widespread protests. In Asia, export-driven economies like Japan and China saw a sharp decline in demand for their products, impacting their growth. Meanwhile, in developing regions like Latin America and Africa, the crisis had a ripple effect, causing a drop in commodity prices and a slowdown in foreign investment. However, some regions fared better than others. For instance, Australia managed to weather the storm relatively well due to its strong regulatory framework and stable banking system. Overall, the global financial crisis had far-reaching consequences, affecting economies in varying degrees across the globe. The road to recovery was long and challenging, requiring coordinated efforts and policy interventions at both national and international levels. Now, let's talk about the actions that governments took to address the global financial crisis of 2008. In response to the collapse of major financial institutions and the subsequent turmoil in the credit markets, governments around the world implemented a series of interventions and rescue plans to stabilize their economies and restore confidence in the financial system. One of the key measures employed by many governments was the injection of capital into struggling financial institutions. This was often done through the purchase of distressed assets or through direct investments in the form of equity stakes. By providing these institutions with much-needed capital, governments aimed to prevent further bank failures and alleviate the credit crunch that was stifling economic activity. In addition to bolstering the financial sector, governments also took steps to stimulate economic growth and mitigate the impact of the crisis on businesses and households. This included the implementation of fiscal stimulus packages, tax cuts, and increased government spending to support infrastructure projects and create jobs. Central banks also played a crucial role by lowering interest rates and implementing unconventional monetary policies to encourage borrowing and spending. Furthermore, regulatory reforms were introduced to address the shortcomings that had contributed to the crisis, such as lax lending standards and excessive risk-taking by financial institutions. New regulations were designed to enhance transparency, strengthen oversight of financial markets, and improve the stability of the banking sector. Overall, the coordinated efforts of governments and central banks around the world were instrumental in stabilizing the global economy and laying the groundwork for recovery. While the road to full recovery was long and challenging, the decisive actions taken during this time were crucial in preventing a deeper and more prolonged economic downturn. Stay tuned as we delve into the lasting impact of the global financial crisis and the lessons learned from this pivotal moment in economic history. Now, let's delve into the long-term consequences of the 2008 global financial crisis on trust in financial institutions. It's no secret that the collapse of major banks and financial institutions during that time had a profound impact on public trust in the financial sector. Many people saw their investments and savings disappear almost overnight, leading to a deep-seated distrust in the stability of banks and other financial entities. But how has this mistrust continued to shape our perceptions and interactions with financial institutions in the years that followed? Well, for starters, we've witnessed a shift in consumer behavior, with many individuals becoming more cautious and careful with their financial decisions. The crisis served as a wake-up call, prompting people to scrutinize the institutions they entrust with their money and to seek more transparency and accountability from those entities. Moreover, the lingering effects of the crisis have led to increased regulatory oversight and compliance measures within the financial industry. This has been aimed at restoring faith in the system and ensuring that such a catastrophic breakdown does not happen again. As a result, we've seen a push for greater transparency, ethical practices, and improved risk management from financial institutions, all in an effort to regain the public's trust. Despite these efforts, it's evident that the scars of the 2008 crisis still run deep in the collective psyche. Many individuals, particularly those who bore the brunt of the financial fallout, continue to approach financial institutions with caution and skepticism. Rebuilding trust takes time, and the repercussions of the crisis are a stark reminder of the importance of maintaining integrity and reliability in the financial world. As we continue to navigate the aftermath of the 2008 global financial crisis, it's crucial to reflect on the enduring impact it has had on our trust in financial institutions. The lessons learned from this tumultuous period serve as a poignant reminder of the need for transparency, responsible practices, and a renewed commitment to earning and upholding the trust of the public. As the dust settled after the global financial crisis of 2008, it became clear that significant changes were needed to prevent similar catastrophes in the future. One of the most important legacies of the crisis was the overhaul of financial regulations. In response to the meltdown, governments worldwide introduced stricter regulations to rein in risky behavior in the financial industry. These changes aimed to promote stability, transparency, and accountability, and to prevent another collapse of such magnitude. Furthermore, the crisis forced the financial industry to reevaluate its practices and risk management strategies. It became evident that excessive risk-taking and a lack of oversight had contributed to the crisis. Consequently, financial institutions had to rethink their approach to risk, compliance, and governance. Lessons were learned the hard way, but the industry emerged with a newfound commitment to prudence and responsible conduct. The aftermath of the crisis also prompted a re-evaluation of the role of central banks and regulators. Both entities faced scrutiny for their supervision and oversight leading up to the crisis. As a result, there was a push for greater coordination and cooperation among central banks and regulators, with an emphasis on early detection and mitigation of systemic risks. Ultimately, the legacy of the global financial crisis is one of resilience, adaptability, and a renewed focus on risk management and regulatory oversight. The lessons learned from this tumultuous period have led to a more robust and vigilant financial system, better equipped to navigate future challenges. As we continue to reflect on the events of 2008 and their lasting impact, it's evident that the crisis served as a catalyst for positive change within the financial industry. While the pain and turmoil of that time cannot be forgotten, the silver lining, is the enduring legacy of stronger regulations, improved risk management practices, and a renewed commitment to stability and responsible conduct. As we look back on the global financial crisis of 2008, it's important to remember that behind all the headlines and numbers are real people whose lives were deeply affected. So today, I want to share some personal stories from individuals who faced the impact of this crisis firsthand. I spoke with Sarah, who was working in the financial sector at the time. She vividly recalls the sense of uncertainty that permeated the office as the crisis unfolded. Many of her colleagues were let go, and she found herself grappling with the fear of job insecurity and the stress of navigating a suddenly volatile market. Then there's John, a homeowner who found himself facing foreclosure when the value of his house plummeted along with the housing market. He describes the strain it put on his family, trying to navigate the unknown and not knowing if they would be able to keep their home. But it wasn't all doom and gloom. Despite the hardships, there were stories of resilience and determination. I also had the opportunity to sit down with Maria, who, after losing her job, decided to pursue her passion and start her own business. She faced countless hurdles, but her unwavering determination eventually led to the success of her venture. These stories are a powerful reminder that behind every economic upheaval are real people, with real struggles and real triumphs. It's through these personal narratives that we can truly appreciate the lasting impact of the global financial crisis on individuals, families, and communities. As we wrap up this episode, it's important to remember that the global financial crisis of 2008 was a defining moment in modern history. It demonstrated the fragility of the financial system and the interconnectedness of global economies. Looking forward, it's crucial to learn from the mistakes of the past and implement safeguards to prevent such a catastrophic event from happening again. It's encouraging to see the efforts made by governments, financial institutions, and regulators to strengthen the financial system and mitigate risks. Remember, history has shown us that economic downturns are often followed by periods of recovery and growth. The resilience of individuals, businesses, and economies play a crucial role in shaping the future. Let's move forward with optimism, determination, and the wisdom gained from our past experiences. Thank you for joining us in this episode as we explore the intricacies of the global financial crisis. Your ongoing support and engagement mean a lot to us. We look forward to having you tune in for our future episodes as we continue to uncover and discuss pivotal moments in history. Until next time, take care and stay curious.